Thank you for being here. Today we have three speakers. Okay, we made a one little change. Mark Waller was not able to be here today, so we have Andrew Wright. He's our district economist in Lubbock. For all of you who doesn't know Andrew, he started here about a year ago, something like that or less. So we'll have it here. He will be replacing Mark today. Okay, we will start with Dr. Robinson. He's going to talk about cotton. Then Dr. Wright is going to talk about grains. And last, Dr. David Anderson is going to talk about livestock markets. So John, whenever you want.
Okay. Can you see that?
Yes, I do.
Okay. So a quick update on cotton markets. The short story is that this sideways band of prices that we've had in this, well, since November, since Thanksgiving, is we've been sort of sideways from about 78 or 9 to as high as 87 or 88, but we spent most of our time right here between 80 and 85, and we're still there. We had last week a bullish supply and demand report. So let me just get to that. This right-hand column here is the new numbers as of August for cotton. The 11 million is what was planted. The 8.62 was what they expect to be harvested, and that was a lot lower harvested than what they were suggesting the previously. So more abandonment, fewer harvested acres. That's going to tighten up the supply picture. So that's kind of a bullish thing. They lowered the yield, so that's going to tighten up the supply picture. That's kind of a bullish thing. So total production dropped 2.5 million bales from 16.5 to about 14. All right, so they're tightening up the supply picture, and that's kind of a bullish thing. With fewer bales produced, they're expecting fewer bales of exports, so they cut this export number down to 12.5. That's not surprising. And the bottom line, if you look down here at the bottom where it says 3.1, that was previously 3.8 million bales in July, and now it's tightened up to 3.1 million bales. So whether Andrew's talking about grains or I'm talking about cotton, it's always the same story. When the final ending stocks or however you're measuring your what's left over, your leftovers, when that gets tighter, then we expect tighter prices. And we saw tighter prices. I'm going to go back here. The day that report came out is the day of this price spike right there. The market liked that report. The market recognized that it was tightening things up, and high prices usually follow lower ending stocks, and that's what we got on Friday a week ago. Prices went up, and everybody thought, hey, are they going to open up higher on Monday? Well, no, they didn't open higher on Monday. They weren't higher all last week. They fell again. So what's going on? If things are tighter, then why did I'll come back to that. Well, the reason the market went down was because last week was totally distracted and totally dominated by another story coming out of China having to do with the Chinese economy slowing down, imploding, melting, various descriptions of it. But basically, their real estate people that invested money in real estate over there were losing money, and consumers are consuming less. And there were just a whole bunch of stories that came out last week, and it affected everything. It affected stock markets around the world. It affected our bond market. It made our interest rates go up, and our bond yields go up, and bond prices go down, and stock prices go down, and commodity prices go down. Oil went down. Grains were kind of mixed. I'll let Andrew talk about that. But cotton just went down. Cotton went down all week long. We basically slid back into the lower end of the range that we've been in. So this is just an example of one of those things that happens because we're in a global market and because cotton in particularly is influenced by how the general economy goes. So if the world economy is sliding because of the Chinese economy is sliding, it'll affect cotton prices. So that can happen, I guess, anytime. Whether it's going to continue or not, I don't know. The cotton market this morning was up about 0.5 cent. So I'd like to think that this contagion, this Chinese economic slump, I hope we're past it, but we'll just have to see. The last thing I'm going to say is, even though they cut 2.5 million bales out of the latest forecast of the U.S. production, kind of what Pancho and Andrew and I were just visiting about, there's still room for adjustment downward, because I think there's a lot of standing dryland cotton that they haven't made a decision about whether or not to zero it out prior to harvest. And this year, I think there's probably more of that dryland standing cotton because it got planted during the rains. So I think there's a lot of dryland cotton in the dryland sandy land regions below Lubbock and all the rolling plains. I think a lot of that cotton got planted late, and I think a lot of it came up and is standing, but it may not yield very much, and it may not get harvested. It may get zeroed out before. So that means there may be another an adjustment to abandonment, raising abandonment, lowering harvested acres, lowering production, tightening up the picture. That may be in our future. We'll just have to see. This list of stuff here is all the different ways that USDA is going to get information this fall to come up with a clearer picture of what the production is. We'll have monthly supply and demand reports, and they'll be doing surveys as part of that. They'll be doing field sampling as part of that. FSA's got certified acreage data that they may release it, and that may tighten up the picture some. We'll have information from the risk management agency about what's getting zeroed out. And USDA conducts surveys of gins and forecasts the level of ginning. And lastly, USDA Ag Marketing Service counts bales that are classed. And so this is the ultimate measure. So this fall, they'll reconcile all these different data sources, and then we'll have a clearer picture. And it could be lower than what it is right now. So there's still room for a bit of a surprise. But I'll just point out, none of the surprises we've had, hey, the crop is smaller, none of those kinds of surprises have made prices bust out to the upside. So I think we're beginning to run out of time. We may get another rally before this harvest is done. Maybe we'll get pushed up to the upper 80s, but we'll have to see. But if this last report didn't push prices up out of the price range, then I'm not sure what will. So that's my summary, and I'll let Andrew and David talk, and I'll be on the call for any follow-up questions. Let me stop sharing.
Now, can you hear me? Sorry, I was talking alone.
No, I didn't hear you, but I'm trying to stop sharing, and I don't see how to do that.
No, you have already stopped sharing.
Oh, okay, good.
Yes.
Thank you.
Hey, quick question. When we talk about the drought in Texas, impact that will have, how much is the impact in Texas on the whole cotton in the U.S.?
Well, it has some impact. We obviously plant more than anybody else, and when we have high production, we'll have half the country's production. When we have huge abandonment like we did last year and like we halfway have this year, then we account for a quarter to a third of the country's production. So, I mean, it's an influence just because of the potential level of production, but there's a temptation anywhere for people to look out their back window and think, well, if Texas looks like that, then there's no cotton anywhere, because that looks bad. And people tend to draw conclusions about the state of the entire country based on their region, and you can't really do that because there may be huge crops coming out of the Delta and the Southeast, and of course then the cotton is a global crop, so it really matters what's going on in other places as much as it matters in Texas. As big and as important as Texas is, we don't determine the whole market.
Excellent, thank you. Hey, any more questions for John? Good. Andrew, whenever you want to start sharing your slides.
Am I sharing?
Yes.
Okay, great. All right.
Hey, Andrew, you might want to click on to make the slides that one. Yes, excellent.
There we go. Wonderful. All right. Well, like Pancho said, I am stepping in for Dr. Welch today to talk a little bit about the grain outlook. I do want to start by thanking Dr. Welch for putting together some of this information for me to present to you today. Today, I want to talk a little, or mostly focus on what's going on in terms of corn production, what we're seeing, and how that's going. How right now, based on what we're seeing, maybe what we can expect in terms of prices later on in the year. And then I'll turn from there to a couple of different current events that could end up maybe muddying the picture a little bit, or maybe changing that picture up depending on how they play out. And then I'll finish up with just one comment on some things that we're seeing in these markets that may impact some planting during in 2024. And so I want to start out. I've got talking a little bit about what we're seeing in terms of corn production. And so what we got here is the WASDE balance sheet for corn as of August. And what I really want to look at is how the August report, or the August balance sheet, compares to July, and put that into context with how July compared to June. So just looking at production in terms of area planted, area harvested, back in July, USDA revised those numbers up about 2 million acres, but then they revised the expected yield from that production down about 4 bushels per acre. Going into this month, no change in planted or harvested area, but they did revise yield down again by about 2.5 bushels per acre to 175 bushels per acre. The impact in terms of supply that we from this change, the net impact is to reduce the total supply down about 155 million bushels, which overall is led to a revision downward in terms of ending stocks for the year of about, or revising down the number for ending stocks by about 60 million bushels. So like Dr. Robinson said, bottom line, when you see that ending stocks number go down, you do expect to see that tightening in ending stocks. You expect to see a tightening in price as well. In terms of what we're seeing as far as crop condition, crop production, I think that last month in this presentation, we had seen crop condition reports up to about this July 9th date. We've seen another 4 weeks of those reports, or another 4 or 5 weeks of those reports. As we've gone through the year, the crop or the corn crop condition has improved. Looking at, if we look particularly at this black line compared to the blue line, so this blue dotted line, that's just the average crop condition, or historical average crop condition over time. Comparing that to the black line, that's this year. That crop condition started out looking fairly poor, fairly below average, but over time, as we look through the end of June, through July, and into August, crop condition has improved, and we're starting to approach that historical average. To put that into a little bit more perspective, here, if we look at the red line, that's the historical trend in terms of crop condition and historical trend in terms of yield. This black line looks at what crop condition did last year in 2022. So we saw that steady decrease down to a final yield of about 173.3 bushels per acre. Then this green line is what we've seen so far this year with the crop condition in corn up to this point. So again, we saw it decrease actually well below trend, even below the 2022 trend, until recently we started to see it go back above and start to approach that historical average trend. So I guess the question is, how does that crop condition trend continue this year? Do we continue to see it increase up to maybe that what would be the average? Does it start to go down again? And that's going to impact what we see in terms of overall yield. I think last month or during last month's update, we were seeing that crop condition right here around 347, which was well below 2022. One thing that was mentioned at that point, USDA was expecting about 177 bushels per acre in terms of yield. We've seen that crop condition increase. We've seen USDA reduce that expected production per acre down to 175. That seems to be maybe a little bit more reasonable, particularly in terms of what we saw last year with the 2022 crop and its condition. And that's what we see when we look at or when we consider maybe a crop that crop condition as the determinant of corn yield. So this graph just looks at historical actual yields for corn over time over the last 40 years or so. That's the black line. This green line looks at what crop yield or what corn yields would be based on a statistical model that predicts corn yields based on that crop condition index. And as you can see, crop condition, those two lines do tend to match up pretty well. All that really means is that crop condition index seems to be a pretty good predictor of crop yields over time. Right now, that model would predict about 174.8 bushels per acre. So the USDA estimate 175 seems to be pretty well right on what that expectation would be. Seems to be a pretty reasonable expectation for what those crop yields or corn yields are going to be this year. Now, as far as what that means in terms of maybe prices to expect, one measure that Dr. Welch likes to use to understand prices is this days of use on hand at the end of the marketing year. It's just the amount of the amount of the commodity, in this case corn, that is on hand for use at the end of the year. In other words, if all production were to shut off, how many days could we continue to use in this case corn after production quit completely? And so in this model, we really look at that days of use on hand as a determinant of the price, or what determines the price. Looking back to right now, the current WASDE, we're expecting about 175 bushels per acre, which would equate to about 100 or about 55 to 56 days of use on hand for the marketing year. And really what we see here is that as that production goes, or as yield goes up, we tend to see that days of use on hand goes up. And as days of use on hand increases, we tend to see that seasonal average marketing price tend to go down. So when we're looking at, for example, what we expect this year in terms of yield, we tend to expect a yield down here at about 175 bushels per acre, about 55, 56 days of use on hand, which would lead us in this model to predict a seasonal average marketing price somewhere around $4.50 to $4.75, which is, I think, a little bit lower than the WASDE report and their prediction for that marketing price. This chart just puts some of that information or that same information just in a little bit different context. This looks at days of use on hand over time across the last 20, 25 years or so. If we look at this days on use on hand for just the U.S. seems to be right in line with the 2017, 2018, 2019 marketing years. And in fact, when we go back to those years, we did see a seasonal average price right around that $4.50 to $4.75 mark. One thing interesting that we've seen here is that that value for the United States and for the world has been increasing over time. This is despite the fact that we've seen an end to the Russia-Ukraine Black Sea deal that protected those Black Sea shipments. So I'm going to shift over. This is one of those things that I talked about, some of those current events that, depending on how they play out over time, could change some of this outlook just a little bit. So a year ago, Russia and Ukraine entered into this agreement that protected grain and other shipments coming out of Ukraine's Black Sea ports, allowing them to get to the rest of the world. That agreement expired on July 17th, and Russia chose not to continue or extend that agreement. And in fact, shortly afterwards, they actually enacted some attacks on one of, then retaliated on one of Russia's Black Sea ports. We haven't necessarily, so we're still right at, I think it was right after that. If you look at the markets, there was a pretty quick spike, a pretty quick increase in price that has disappeared at this point in time. So we're still waiting to see how this is going to play out. At this point, we haven't seen really the ending of that agreement change that final days of use on hand number. We haven't seen it really impact the supply of corn available or the supply of wheat available at this point. But depending on how that plays out, depending on how that impacts those supplies over time, we could start to see those markets tighten up. We could start to see those prices tighten up as well. The other big event or current event that depending on how it plays out, could change some of this outlook is just the big question of what happens with our current fight against inflation. So these next couple slides just try to put some of that fight into context, what's changed and how inflation, how employment, how the federal funds rate has changed over time. And so in this case, you might remember just over a year ago, we saw that very, very high inflation. I think this is the personal consumption expenditures index, which went up to about 7%. The CPI, the other big inflation measurement, consumer price index, I think was up around 9% at that point. Just a little bit before, so a little bit over, right around a year and a half ago, the Federal Reserve started to increase those interest rates in order to fight that higher inflation, and increase them. I think in May they increased interest rates, or made their last increase in interest rates up to the federal funds rate, put the federal funds rate right up around 5%. And what we see here is that as that interest rate has gone up, we've certainly seen the inflation rate go down. We have not seen necessarily this green line, the employment rate, start to tick up. Obviously the Federal Reserve wants to be very careful in terms of how it increases those rates in order to keep the unemployment rate from going up quickly or too quickly and potentially pushing the economy into a recession. And especially over the last maybe 6 months or so, we have started to see some progress made in that fight against inflation, though that inflation rate has gone down quite a bit, but we still have quite a bit of ways to go. One reason for that, if we look at the core inflation rate, it hasn't changed quite as much. So the difference between the inflation rate and the core inflation rate, core inflation doesn't include expenditures, consumer expenditures on food or energy, which tend to be very, very volatile and tend to move that inflation rate either up or down quite a bit. Core inflation doesn't account for those, and what we've seen in terms of core inflation is essentially a spike or hitting a high of around 5.5%, just a little bit under 5.5% about a year and a half ago, and then staying fairly stable, not really going up or down very much over time as the Federal Reserve increased that interest rate. We've finally started to see that interest rates start to decrease here as the federal funds rate has gotten high enough. It's gotten above that core inflation rate. And so really the big question here in terms of the future, what's going to happen to this red line, this trend, as we move from August into September to the Federal Reserve's next meeting, or the Open Markets Committee next meeting, which is going to be, I believe, at the end of September, around September 20th or 21st. One thing I will say is that the target inflation rate is around 2%. So we still have about 2% or 2 percentage points to go in order to get the inflation rate down really where the Federal Reserve wants it. So the big question is, does this line level out? Does it continue to go down? Does it start to go back up? If it levels out, if it starts to go down, I think we'll probably see that federal funds rate stay right around where it is. I don't know that they're going to necessarily start to decrease that rate quite yet. If that inflation rate stays steady or starts to increase, we'll probably see that federal funds rate go up again as well. So something to keep an eye on as we move forward into the next into the end of the year. So I'll finish up my update talking a little bit about maybe what's coming up in 2024 in terms of planting. One thing that we've seen, particularly through the last month is that soybean prices have been relatively strong, or 2024 soybean prices relatively strong compared to corn. This graph just is looking at or compares this blue line, which is the 2024 November soybean contract price, to the 2024 December corn price. And so we see through June, through July, or rather as we look at these prices, historically they've tracked together pretty well until the end of June through July. At that point, soybean prices started to get very, very strong relative to corn prices. Corn moved up, soybean moved up, and then as corn moved back, the price moved back down. Soybean went down a little bit, but it's still very, very strong relative to that December 2024 corn price. What this means is that potentially, if this continues, there's a potential that we'll see maybe a shift in terms of planted acres next year, 2024, away from corn back into soybeans. If that's the case, that would be bullish for those corn prices going into next year's planting season. So I will go ahead and finish my update there, and I'll stay on the call. And if there are any questions, I'll be happy to answer them as best as I can.
Thank you, Andrew. Great presentation.
Thank you.
Any questions for Andrew? Now, David, are you here? Good
Well,
to see
we're
you.
about to find out.
I'm glad you are.
I think I've downloaded Teams about 15 times today trying to make it work. And then miraculously, it just happened. So let's see what we can do. There we go. Hancho, you got it?
Yes.
Okay, great. Shoot, I got a bunch of slides today. Really, sort of a heck, I probably do this every time. Sort of a shotgun effect of some things that I think are interesting. I'll cover a couple different species, but let me start with retail beef prices. The latest, the CPI data came out, and if we pull the beef part out of there, we got retail beef prices at a record high. In fact, it's the third month in a row setting a new record high. The price for choice beef, that's across all cuts, was $8.30 per pound. We got tighter supplies, and people are still buying. And so that's driving those prices up. Now, you might notice that the red line at the bottom is that kind of a 5-year average that I like to use. And you know what? It typically goes up to mid-year and then begins to come down just a little bit. A lot of the driver of that is even if I went back and took out the pandemic in 2020, which is part of that increase, we still get a little rise, and it's really related to grilling season. And then we sort of get past the beginnings of that and a lot of pipeline kind of purchases, and then it starts to trail off a little bit into fall. So I think there is, I would have some expectation that even with tighter and tighter supplies, we may have a little effect of that normal seasonal pattern, because we certainly see that in some underlying wholesale cuts. And if I showed the box beef cutout value, sort of this wholesale value measure, this last month, let me go back to that one, but last month's, the July retail beef prices are really reflecting this big run up in the wholesale cutout value for choice beef back in June. And it's pretty easy to see that that's come down in terms of wholesale value. Even in the face of declining beef production, wholesale values have come down. And so, we may see some moderation in that, but still the overall level of retail prices is going to stay high. I mean, people are buying, they continue to buy beef, and we have tighter and tighter supplies. And heck, the auction market, you can see what's happening with prices. I just pulled one weight class, 500 to 600 pound, number one steers, kind of Southern Plains, in a steady increase throughout the year. Backed off just a touch in the last couple of weeks. If I looked at 4 to 5, 100-pound steers in this same market area, we hit $3 on average last week. So certainly higher prices. Feeder cattle are higher priced as well. Really just plain tighter supplies. So anyway, I include that just sort of for some completeness here, that we're seeing prices throughout the supply chain here. Friday afternoon, USDA had released its cattle on feed report. So I thought I'd throw out about 3 charts here to kind of touch on that. Placements, the blue line this year, placements declined. In fact, they were down 8% compared to a year ago. That was within the range of pre-report estimates. I had placements down 4%. Placements ended up down 8%, a much bigger number. But it's certainly not out of that shouldn't be seen as some kind of outlier or some big surprise. Heck, if we look at May and June, we actually had placements greater than a year ago, even though we know we have a smaller, cow herd, fewer calves. In fact, placements had been, I thought, over the year so far, actually a bit large compared to what we think the calf crop is. And so that we get some kind of bigger decline like this, we really, that makes sense in the bigger picture. The thing that we're not going to know really until the October cattle on feed report is the breakdown of the number of heifers versus steers. And so one of the questions I have looking forward to that report is, when we start to see some herd rebuilding nationwide really take off in earnest, we ought to see a declining number of heifers on feed. And so one question might be, is part of this big decline in the number of placements related to fewer heifers going to feedlots and more being retained? I don't think there's much clear evidence yet of that. If I take placements for the whole year compared to placements for the whole year last year, we're down about 2.3%, which is pretty darn close to what the estimate of the calf crop was down. And so placements aren't giving us much evidence of widespread herd rebuilding from the heifer side yet at this point. So, but there's plenty of time left for that to start happening this year, if it's going to happen. The other thing I suggest is we probably ought to think about this as highly dependent on the region and the range and pasture conditions that we're in. Y'all know what a lot of our conditions are like over the last several months. That probably holds us back. Yet we have some places in the northern plains that have abundant grass, have had recovery from drought last year and early this year. And so the potential may be there for some folks there to expand. So I think it may be a real hit or miss and regional type thing getting started. So anyway, that's in the report. Big decline in placements. Marketings were also lower, down a little over 5%. Pretty much what was expected, with fewer cattle on feed, fewer marketings. The timing of placements, particularly relatively more lighter weight placements, takes longer to feed them, and so we've got more cattle on feed compared to a year ago that had been there more than 120 days. They just aren't quite ready yet, so we've got marketings that are lower, really consistent with fewer cattle on feed. And so the total cattle on feed numbers, we're down to about the 5-year average. Really seeing fewer numbers on feed because we just plain have a smaller cow herd and fewer calves, and it really is reflecting in cattle on feed. So, and the number there was down like 2%, not unexpected in the pre-report estimates, but probably pretty supportive of prices too going forward with just fewer animals on feed. I thought I'd point out beef cow slaughter. I've gotten a lot of questions lately about herd rebuilding and prices. So mentioned a little on heifers. If we look at cow slaughter is clearly running below a year ago and has almost every week this year. If we went back to sort of May, June, and early July in this data, we were pushing 70,000 head per week. And that would have suggested, really that's a fairly large number with a smaller cow herd. But seasonally, we do cull more in that June kind of time period. So I think the interesting part in this that we're really starting to see is the last 3 or 4 weeks, a lot fewer cows going to slaughter compared to a year ago. Last year's number was big in all of these weeks. And so, the thing I'll be looking for in the data going forward is this consistently, are we widening this gap to last year? When we get to the fall, when most culling happens around the country, do we really see a sharp decline in cow numbers going to slaughter, implying that we're holding more of those cows and maybe setting the stage to kind of start some rebuilding from the cow side? So that's a really wide gap from week to week compared to a year ago, and really indicative of fewer cows going to market. Another little thing I find interesting in the fed cattle data, we get weekly data on the number of cattle that are graded, that grade prime, choice, select, and no roll. I think one of the interesting things is if we take a look at the number of cattle grading choice, or the amount of beef grading choice that is graded, over the last about 6 weeks, well, more than that, a couple months now, we've been running below a year ago. And, quite honestly, what's contributing to that? We've got weights about the same as a year ago. Is the heat contributing to that? I think that might be a reasonable explanation. But the fact is, we've got a smaller percent grading choice when our beef production is lower. And so one of the things driving a choice select spread then is reduced amount of choice being produced relative to other grades. And so what we have is a choice select spread that is historically pretty wide. It's actually a little smaller than a year ago, but we actually have something that's historically pretty wide. And if we think about where so much demand growth has been for higher USDA quality grade, what this suggests is that we're really seeing a cut in production or supplies of choice beef. So if we go back to that retail price slide that I used at the very beginning and showed record high retail choice beef prices, we're actually producing even less choice beef than we were a year ago, even with our total volume of beef lower. So I think that makes some sense as well in terms of putting this all together. People like higher quality grade beef. It's got more marbling. It's heck, that fat's good. Darn sure tastes good anyway. And that's been this part of this demand mix. And so I think a lot of these parts and pieces really hang together. Relatively even tighter supplies of choice, high prices for choice, whether we're talking the cutout or the retail market. So anyway, that's something we don't usually talk about very explicitly, but I think it's something pretty interesting in the data that I think we may hear more about in some of the trade news, is this really relative cut in the amount grading choice. I threw in a lamb slide. We got some new data on trade, a trade update. So we've got the June data for lamb imports. As you know, imports are, we import more than we produce ourselves, and so it often has a big effect on lamb prices. I think one of the encouraging things in this overall market is that we're bringing in much less than we did a year ago. We're about on that 5-year average, and so from a total supply standpoint, we've got fewer imports and we're producing less domestically ourselves, and I think both of those are pretty positive. If we look at lamb production been running below a year ago for certainly a large number of weeks since the first quarter of the year. We've got less production than we did a year ago. So from an overall supply standpoint, I think it gives us some hope there for some rising prices. I think our biggest problem though is on the demand side right now, but some tighter supplies at least gives us some sort of foundation for some better prices. You know, if you want some more in-depth slides on the lamb market, last Thursday, I did a lamb market outlook program for the California Wool Growers Association. Their annual convention was last week. So I've got that set of slides. If anybody's interested in the full set, just heck, send me a note. I'd be happy to share those. And if you need any explanation for some of them, let me know and we'll get that in there too. But I've got a full set of sort of lamb market stuff for that group last week. And then I haven't done a goat thing in a long time, but I just thought I'd include a price chart. These are 40 to 60 pound number one kids at the San Angelo auction. And, you know, heck, we had lower prices than a year ago, but we had just shockingly record high prices in the first half of last year. Last couple of weeks, we've kind of bumped up ahead of a year ago, but really, I might argue that more of that is we may be sort of already a little early to our normal seasonal increase in prices. And so just for your viewing pleasure, I included a goat chart just because, you know, that's I think a growing market and a pretty interesting market for a lot of us. So that's there. If you need that one, let me know as well. And my last slide is simply another pitch for Southern Ag Today. Our livestock articles last week and the one that's coming out tomorrow deal with kind of some economics of replacements, of heifer's replacement. Are we seeing any growth? What's in the data? Are we, you know, what are factors that are affecting heifer retention and the potential for kind of turning around and high prices getting us to start expanding? And so that's last Tuesday's article, and the one tomorrow we're dealing with that topic. So those might be of interest to you as well. With that, I'm going to stop. I think I can end the show, and we'll get back to that one if we need to. If I need to get back to any of those slides, we'll get back to them. So any questions for me, guys?
Thank you, David. You are still sharing, but it doesn't matter. But thank you very much.
Oh,
great presentation.
Yeah. There we go.
Hey,
that's better.
Anyone has any questions for David?